Corporate finance. Corporate finance in CFA Level 1 focuses on how organizations make financial decisions that maximize shareholder value while balancing operational efficiency and strategic growth. The curriculum introduces organizational structures, ownership forms, stakeholder relationships, and corporate governance principles that shape business operations and financial performance. Candidates learn how publicly and privately owned companies differ in financing, reporting, and governance practices. The topic also explains how stakeholders such as shareholders, creditors, employees, regulators, and customers influence corporate objectives and decision-making. Environmental, social, and governance considerations are increasingly important in evaluating corporate issuers and investment opportunities. Corporate finance builds a strong understanding of how businesses operate financially and how management decisions affect profitability, risk, sustainability, and long-term enterprise value creation. Corporate governance is a major component of corporate finance because effective governance supports ethical management, accountability, and sustainable corporate performance. The curriculum examines principal-agent relationships and conflicts that may arise between managers, shareholders, creditors, and other stakeholders. Candidates study governance mechanisms designed to align interests and reduce risks associated with poor decision-making or unethical conduct. These mechanisms include board oversight, compensation structures, shareholder rights, and regulatory controls. The curriculum also explains the consequences of weak governance practices, including operational inefficiencies, financial misstatements, reputational damage, and reduced investor confidence. Strong governance improves transparency, decision quality, and stakeholder trust, which are essential for maintaining access to capital markets and supporting long-term shareholder value within increasingly competitive global business environments. Working capital and liquidity management are critical topics within corporate finance because companies must maintain sufficient short-term financial resources to support daily operations efficiently. Candidates learn how to analyze the cash conversion cycle, liquidity levels, and working capital management policies used by different organizations. The curriculum explains how companies manage receivables, inventories, payables, and cash balances to optimize operational efficiency and reduce financing costs. Effective liquidity management ensures that businesses can meet short-term obligations while supporting growth opportunities and maintaining financial flexibility. Candidates also study how liquidity positions vary across industries and business models. Understanding working capital management helps investment professionals evaluate operational efficiency, financial stability, and management effectiveness when analyzing companies across different economic and competitive conditions. Capital investment and capital allocation decisions are central to corporate finance because they determine how organizations deploy financial resources to create long-term value. Candidates study capital budgeting techniques such as net present value, internal rate of return, and return on invested capital to evaluate investment opportunities. The curriculum explains how companies prioritize projects, allocate capital strategically, and avoid common allocation mistakes that reduce shareholder value. Candidates also learn about real options, which provide management flexibility in investment decisions under uncertain conditions. Understanding capital allocation principles allows analysts to assess whether management is making efficient investment decisions that support profitability and growth. These concepts are widely applied in mergers, acquisitions, expansion projects, technology investments, and long-term strategic planning across industries and markets. Capital structure analysis examines how companies finance operations using debt, equity, or hybrid financing instruments. Candidates learn how to calculate weighted average cost of capital and understand the relationship between financing decisions, risk, and company valuation. The curriculum explains factors influencing capital structure choices, including taxes, financial flexibility, industry conditions, and business risk. Candidates also study the Modigliani-Miller propositions, which provide theoretical perspectives on capital structure relevance under different market assumptions. Understanding optimal and target capital structures helps analysts evaluate whether a company's financing strategy supports sustainable growth and efficient capital use. Corporate finance emphasizes that financing decisions influence shareholder returns, borrowing costs, credit risk, and long-term competitiveness, making capital structure analysis essential for investment and corporate evaluation. The corporate finance curriculum also explores business models and their importance in understanding how companies generate revenue, control costs, and sustain competitive advantages. Candidates study different business model structures and evaluate how operational strategies influence profitability, scalability, and financial performance. Understanding business models enables analysts to interpret financial statements more effectively and assess the sustainability of earnings and cash flows. Corporate finance integrates strategic thinking with financial analysis, helping candidates connect operational decisions with shareholder value creation. The topic provides essential knowledge for evaluating management quality, financial health, and corporate strategy across industries. Mastery of corporate finance supports investment analysis, equity valuation, credit assessment, and portfolio management by strengthening the ability to evaluate the financial and strategic drivers of business performance.